Most people think they know how their mortgage works, but what if I told you there's a part of your mortgage that hardly anyone ever talks about, and it's the part that costs you the most? You see, when people think about their mortgage, they're usually focused on one thing, and one thing only: the rate. But the real truth is, it's not just the rate that determines what your mortgage is going to cost you. It's how much interest you're actually going to pay over the life of your mortgage. And when you see those numbers, they're probably going to surprise you, because they definitely surprised me. So let's start with a question. When you think about your mortgage, what's the first thing that comes to mind for you? Most people say it's rate, 5%, 4%, 3%, whatever the number the bank gave them. Could be the mortgage payment. The rate becomes the only thing for me that most people focus on. But here's the thing, the rate isn't the real story. The real story, the one almost nobody talks about, is how much interest you're actually going to pay over the life of the mortgage. And that's why I'm spending so much time on this video. And actually, here's where the big myth really falls apart. Most people think if I borrow $500,000, I'll pay it back plus a little bit of interest. But that's not how mortgages work. Over the life of a typical 30-year mortgage, you're actually going to pay about the same amount in interest as you do in principal. Think of it like this. When you buy a home, you're really buying two. One for you and one for the bank. If you borrow $500,000 at 5%, spread it out over 30 years, your monthly payment's going to be about $2,684. When you add that up over 3 decades, you're roughly going to pay $960,000 in total. That means $460,000 of it is pure interest, money that goes straight to the bank. So even though your mortgage says $500,000, you're really almost paying $1 million. You're buying one home for yourself and another one for the bank, right? Because a 30-year mortgage isn't just a long commitment. It's a story of where every dollar of your payment really goes. So in this video, my goal is to break it all down for you step by step and show you how to turn those numbers in your favor. So let's break it down for you. So over 30 years, you're going to pay back $500,000 loan plus $460,000 in interest. Almost half of everything you pay never touches your mortgage balance. It doesn't build equity. It doesn't increase your net worth. It simply goes to the bank's profit column. When I first saw these numbers myself, I honestly made my stomach drop. I thought, how many people are working 30 years to pay for a house that the bank already owns half of? And this is why understanding amortization really matters. Interest isn't just a one-time cost. It's built into every single payment you make. And that structure, it's designed to favor the lender, not you. So let's look at your very first mortgage payment. So on a $500,000 mortgage at a 5% interest, your total monthly payment is going to be about $2,668. So here's the breakdown. Roughly $2,062 goes to interest and only $606 goes towards your principal. Think about that. Almost 80% of your payment doesn't reduce your balance at all. It's just covering the cost of borrowing. That's why your first year, you're barely seeing your balance move. The bank collects their profit first. Now let's fast forward 5 years. Anything change? Let's look. 5 years later, your payment's still the same amount, $2,668, same mortgage amount due each month, but the breakdown shifts just slightly. So interest drops to $1,929 and your principal climbs to $739. So yes, you're paying a bit more towards your home, but the change is so small. And even after 60 payments, the majority of your money still goes to interest. By the end of 5 years, you've roughly made $160,000 in payments, but only $47,000 of that reduced your balance. The other $113,000 went straight to the bank. That's the reality of long amortization. So in the early years, you're mostly building the bank's equity, not your own. And once you see that clearly, it's easy to understand why trying to shorten your amortization or using prepayment privileges can have such a massive difference. And I'm going to show you exactly how that works, because every extra dollar you put towards principal is going to help you to own your home faster and pay the bank a lot less. So let's take a look at this amortization curve to nail it home here. So the blue line is your mortgage balance. It slowly drops over 30 years. The green line is your equity. It rises as you pay principal. The pink line is the interest that the banks make, the bank's profit. At the start, the pink line just shoots up right away, while the green line barely moves, and that's because most of your payment is going towards interest. It's not your imagination. Your balance doesn't drop quickly in the first few years because the system is absolutely designed that way. The bank earns first, you earn later. So when? Around year 17, something big happens. That's the moment where, for the first time, more of your payment goes towards principal than interest. So roughly $1,400 now is paying down your balance, while about $1,260 is going towards interest. It takes nearly half your mortgage term before you start keeping more of your payment than the bank does. Okay, now that you know how your mortgage actually works, let's talk about what you can do about it. Because while amortization is designed to work in the bank's favor, you actually have tools built into that mortgage that can help you flip the equation in yours. So most Canadian mortgages are going to come with something called prepayment privileges. These are built-in options that let you pay down your mortgage faster, and you can do it without paying a penalty. So what can you do? On most mortgages, you can either increase your regular monthly payment by 15% or even 20%, and that adds up fast. You can make a one-time lump sum payment, from a bonus, tax refund, or savings, or you can make annual prepayments, say $10,000 a year directly towards your principal. And here's the exciting part. Just by using these privileges, you could save over $240,000 in interest and cut your mortgage timeline by more than 14 years. So same house, same rate, same income. The only difference is your strategy. Now let's take a look at these two charts now. On the left, we have that standard 30-year mortgage. You can see how slowly that blue line balance drops. Takes nearly 17 years before you really start to move the needle there. And then on the right, you have the same mortgage, but now you're using prepayment privileges, a 15% monthly increase going towards principal and a $10,000 annual lump sum. Look at how fast that blue line falls now. The mortgage is gone in about 15 years instead of 30. You save $240,000 in interest and own your home more than a decade sooner. That's the difference a little strategy makes. So let's take control. Now that you see how amortization really works and how a few smart moves can save you years of payments and hundreds of thousands of dollars in interest, the next step is simple. If you'd like to see exactly how much faster you could be mortgage free, let's just set up a call. Doesn't cost you anything for me to run the numbers. I'll walk you through your numbers, show you how to use the tools that can help you reach your goals sooner. Or, hey, if you want to explore this on your own, I've got an amazing mortgage app. You can try running these numbers yourself. Go inside my mortgage app. It's free to use. It lets you test out different prepayment options, see your amortization curve in real time, and find out exactly how much interest you can actually save. So just head over to kavanaughmortgages.ca or scan the QR code on the screen and you can download the app. So let's start today. Because if you keep paying the way the bank set it up, you'll hand over nearly $500,000 in this scenario and never see it again. But if you take control, even just a little, you can cut that in half. Bye for now.